Good morning, all. Thanks a lot for joining on a Saturday morning. In this webinar, or let's say today's topic is from FDs to PMS. So most of us, let's say for example, even in my family, what we have seen is, let's say traditionally once we shift to let's say retirement, we depend on few factors like fixed deposit or rental income for let's say meeting our monthly expenses and needs and wants. But there are other things also that you need to consider because you just don't want to let's say preserve your capital. You just also want to compound your capital at a better growth rate for your long-term needs and requirement. So rather than just having a retirement, you can create a great inheritance corpus too. So in this, let's say topic, we are going to talk more about systematic withdrawal plan, or let's say how efficiently FD to PMS strategy or FD to mutual funds can suit for your basic needs. So hence, let's see how we can utilize investments in mutual funds, equities, PMS, tagging along with FDs to have a smart retirement income strategies that don't compromise your growth potential on your portfolio. So before we deep dive, let's start with a quick poll. So how long do you want your savings to last? Option A, 20 years. Option B, 25 years. Option C, 30 years. So I would request you all to put your numbers in the chat box. Let's say you retire at 50. How long do you think you want your corpus to last? So we can make it more on an interactive session so that it's like if any doubts and queries are there also, you can please comment and I'll be happy to address the same. Someone has said 30, 25. Perfect. So it's like the idea is 20, 25, 30 is what, let's say, for example, an average, what we're expecting. But do we believe it's like just having a combination of fixed deposit is going to help us reach that? And here's a simple calculation to make this real. If you need 1 lakh per month, that's let's say 12 lakhs a year over 25 years, you would need approx 3 crores, and that's before even considering inflation or any growth rate of FD or PMS and so on. So my question to you is, are your current savings and FDs really designed to last that long? This is exactly what we're going to decode in this session. So now let's talk about why retirement planning today demands more precision. So we are living longer than ever. Let's say thanks for the advancement in the healthcare industry and so on. Many of us could live well past 85 years too. That means retirement could easily last 25 years or more. So and while we're living longer, costs are let's say rising faster than expected, general inflation in India is around 5%. But health inflation that we see is around about 12 to 14% on a yearly basis. For context, healthcare costs can double every 5 to 6 years as far as your, let's say, equity portfolios and so on, if we compound it at that rate. So here's the challenge. A one-time plan is no longer enough for your retirement plan. Life throws surprises, let's say sudden medical needs, family obligations, commitments, emergencies, and so on. Which brings us to the key question, are you planning for just enough or for a comfortable safety margin that actually gives you peace of mind? Because obviously, let's say we would have an idea that after retirement, we don't want to depend on anyone for, let's say, meeting our monthly expenses, needs, and wants. So similarly, let's say, for example, once you're on a job, we believe that financial freedom is something that we don't want to depend on a job for, let's say, meeting our needs and wants. So that's what financial freedom means. Similarly, financial freedom in retirement means that we are not depending on anyone to meet our monthly expenses and needs and wants. So let's say, for example, now let's talk about what, let's say, we assume as safe of, let's say, what are the hidden weaknesses of, let's say, for example, having your portfolio entirely, let's say, having mapped in FDs. So quick question for everyone. How many of you believe FDs are a safe retirement option? So let's say, for example, if I give a point of view that, okay, you have built, let's say, 1 to 2 crores of retirement corpus, how many of you would actually just park it in FD to meet your monthly expenses, wants, and needs? So I assume it's like everyone would like to have some capital growth and no one doesn't want only to park their, let's say, money in the FD corpus. So actually, here's the reality. Yes, FDs sound safe, they feel safe, but look at the hidden weaknesses that this investment also would have. One thing is there is no capital growth. Your principal stays flat and gets eaten away by inflation over a period of time. Let's say, for example, your inflation that I said was general inflation in the range of 4 to 6%. Healthcare inflation in the base of 12 to 15%. Your FD returns that you get is 7%. Post-tax, it would be in the range of 5.5 to 6%. For a senior citizen, you would get a higher, let's say, rate. Post that, returns are taxed every year, which means your real earnings are even lower. That's what I said as post-tax, it's going to be more lower than 7% mark. And here's an example. So you have 1 crore and you're withdrawing 50,000 to 75,000 per month. In about 13 to 15 years, that corpus could be completely depleted if you're dipping into both interest and principal and not just your interest component from your FD. The key takeaway here is low risk doesn't mean guaranteed security if your costs are rising on a continuous basis. So these issues of, let's say, for example, having entire corpus in your FD won't show up on day one, but 5 to 10, 15 years down the line, they can significantly erode your entire retirement security in your golden years. So this is one interesting, let's say, example that I put together. So in this case, let's say I spoke about how just parking your entire, let's say, retirement corpus and just depending on a monthly income, currently, let's say 40,000, how it's not going to work out. Or let's say considering, let's say your purchasing power parity, your capital growth, or let's say your tax outgo, over time, you will have to dip into your principal also. So let's say, for example, my monthly, let's say, income that I'm expecting from my FD is 40,000. Let's say I am parking 1 crore in this fixed deposit corpus and I'm getting a good decent 7% growth rate. After, let's say, slab rate taxation of 20 to 25%, I am paying around about, let's say 1.8 lakhs or 2 lakhs for my tax. Post that 5.2 lakhs is the post-tax gain that I make. So monthly I'm withdrawing 40,000. So do you think this 40,000 is going to be the same withdrawal that I'll need after 10 years down the line? No. Inflation would be higher, your emergency expenses, your healthcare costs are going to keep on increasing on your retirement timeline. So hence at that time, what would happen is we would, let's say once a medical bill comes in, you would go and tap into the principal balance. Then drastically over a period of time, once the principal is also depleted, your monthly income from that is also depleted. So to match up that monthly income, you would again go and withdraw from your FD corpus. And one big pain point is, let's say, for example, if your 1 crore, let's say FD is locked into tranches of, let's say, 5 lakhs or 10 lakhs and so on. And if you need to withdraw a portion of it is just 1 lakh for your emergency expenses, you cannot just, let's say, partially withdraw 1 lakh. You have to break in the entire 5 lakh tranche or 10 lakh tranche. So hence, that is also one of the drawbacks that I wanted to show out. So hence, here, if you see, we are not considering inflation growth rate on this, let's say, assumption. And hence, this over a period of time won't be a good strategy. Obviously, you will have to tap into your principal corpus and then over a period of time, it will be depleted. So one thing would be is we spoke about, let's say, for example, having FD as, let's say, a retirement income plan and so on. So while talking about retirement, one thing would be is there is a strong requirement of a foundation for any sustainable retirement plan. So I generally call this 4 pillars. The first pillar is capital preservation. This is about protecting your money you have saved over a long period of time of 20, 30 years because it's your hard-earned money. You want to save it from any risk like inflation, market drawdowns, or so you don't lose your hard-earned money or hard-earned capital. The second pillar is growth. So one thing is your investments need to grow over a period of time to outpace inflation and, let's say, increase your retirement corpus. Suppose that, let's say, the third important thing is that we generally don't talk about, let's say some people, we talk about it a lot, that would be the tax efficiency. So how you manage your investments can significantly, let's say, affect your taxes that you pay during your retirement. So impacting your overall returns, a tax efficient portfolio helps you keep more of what you earn. So I have a simple thumb rule. Let's say if you're a salaried person, you're working 12 months and earning an income, 3 months to 4 months of your income goes for government for the tax purposes. After that also, let's say whatever savings that I make of that 8 to 10 months, then I go and park into an asset that's going to be again, let's say on a higher slab rate or tax, lower tax efficiency, then I'm losing my capital. So in that case, there are other investments that you can explore that gives you a good tax advantage, and tax efficiency is actually one of the important pillars. Finally, the fourth pillar is predictability. You want a reliable stream of income or clear visibility on your financial status so you can plan your retirement lifestyle without any surprises or any sudden jerks. So it's important to note that ignoring even one of these pillars can, let's say, ruin or, let's say, the entire plan can be unstable. For a truly sustainable retirement, all these 4 needs to work together. So let's say, okay, we'll go to a case study. So meet Ashok. So his current situation, he is currently 50 years old. In this case, he's an IT professional. He's having a monthly income of 2 lakh and he has an expense of 1.3 lakhs. Let's say his monthly savings is 70,000 and he wants to retire in 5 years. Expected retirement duration is 30 years. That is, let's say till 85 years of age, he wants to retire. Considering his lifestyle and let's say his requirement, he needs a corpus of 3 crores to maintain his current lifestyle of let's say for example 1.3 lakhs and so on for the entire retirement phase. So let's say for example what Ashok has done. So let's say Ashok did is he opted for the traditional route. So whatever savings he built over a period of time of last 30 years to 20 years of his work life, he parked the entire gratuity, retirement, DPF benefits entirely in the FD of 3 crore. Corpus was fully locked into an FD. So what are the drawbacks here? First we'll read out is FD returns. One thing is it's not inflation adjusted. Corpus would remain stagnant for 30 years without let's say growing the wealth. Higher tax outgo, and let's say in case of emergency we'll go and deplete the principal, and hence which would again let's say penalize you and reduce your monthly income. In that case, do you still believe it's like let's say if I am 50 years old currently, I'm withdrawing a capital of 1.3 lakhs or expecting let's say net income of 1.3 lakhs from my FD corpus? Would you think 5 years down the line that's going to be same? Even 5 years back, a milk packet was let's say that was costing let's say 15 to 17 rupees. Currently it's in the range of 25 to 30 rupees and so on. So in that case, obviously, based on your lifestyle and your expenses, you would need a inflation adjusted flow in your retirement, and it cannot be fixed like something like an FD. So I'm not going, let's say, fully against FD. Obviously, you need some predictability and more safety in your retirement. So hence, FD is a great tool to manage it. But locking in your entire capital won't be a good fit. So what here, and I thought what we do is, so it's again gonna depend on let's say person to person, individual to individual, and let's say what their expectation is from the retirement corpus. So what we generally do is we create 2 buckets for our clients. So I'll just move to the next slide. So yeah, so hope this screen is visible. So what we generally do is we create 2 buckets for our investors. So this bucket is going to be again different based on the investors' risk capacity, the time horizon, their experience in market, and everything. A lot of other factors too. But for an example purpose is what I have done here. So let's say, for example, 1 lakh was the requirement on a monthly basis for Ashok meeting his monthly expenses. So if you see, there are 2 buckets on the screen. The bucket on your left hand is equity bucket. The bucket on your right hand is the debt bucket, or it can be FD or a debt fund or an arbitrage fund and so on. So the growth rate I've assumed here is very conservative of 9%. And in debt, I've assumed a growth rate of similar as per an FD of 7% and so on. So what we're generally doing is, let's say 1 lakh is your monthly expense. 1 year expense is 12 lakh. Into 5, that is 5 years of your expense would be approximately 60 lakhs. Let's say, rather than blocking your entire 3 crore corpus into FD or a debt fund, I block 50 lakhs from that 3 crore corpus into a debt fund to give me a stable 5 years expenses. So what would happen is, let's say, for example, if you see on the left bucket, from 3 crores, I'm withdrawing 50 lakhs and shifting into my right bucket as an opening balance of 50 lakhs. From there, considering a 7% growth rate post-tax and all, I can comfortably withdraw inflation adjusted 12 lakhs on a yearly basis. Because here, if you see withdrawal that you have seen on the right side is inflation adjusted. It's not stagnant the 12 lakhs for lifetime. 12 lakhs inflation adjusted next year is 12.7. Then 13.4, 14.2 and so on. And this is also not, let's say, fixed that you need to withdraw inflation adjusted. It can be, let's say, variable. We have very much flexibility with a systematic withdrawal plan. You can pause it at a certain month if you don't want, or you can withdraw a higher amount if you want in a certain month and so on. In that case, what happens is at the end of 2028, my corpus of 50 lakhs is fully redeemed. And the closing balance is approximately 5.9 lakhs on the right side. So if you see on the left side, after withdrawing 50 lakhs, my 2.5 crores corpus is again grown to 3.2 crores in 2028. So what I'll do is 2029, again, I'll withdraw 5 years of expenses and shift to a debt fund or an FD or an arbitrage fund and so on. So if we keep this, let's say, going on to, let's say, 80, 85 years of time, in the earlier scenario, if you see, what is the capital that I had in 2055? It was approximately 3 crores. If you see here in 2055, with having a proper plan of capital preservation, stability, and growth, you had a good 6 crores portfolio. That is 4.2 crores in your equity component and 1.7 crores still in your debt component. Obviously, here I've just done it for an example basis. Obviously, it's not going to be, let's say, 5 years block fixed for everyone. Based on your needs and requirement, it can be very flexible. And let's say, for example, there are times like this when market is something that's not very attractive, and we believe next 12 to 15 months can be a bit volatile. So in that period, let's say we don't only go for 5 years, we would be happy to shift your 7 years of expenses and shift in debt fund. whenever we do some profit booking in your equity, then also we can shift and let's say move to debt fund and so on. So hence, I would say it's very flexible and we don't have to, let's say, lock into something like an FD, and your retirement needs more attention because you have worked for it all your lifetime, and obviously your expenses and something that is not very predictable. You want a proper plan for the same. So hence, systematic withdrawal plan is what we can, let's say, do for you in your retirement and help out, let's say, charting a good plan. Now, as we spoke about, let's say, for example, the systematic withdrawal plan, or let's say what are the main foundations of your retirement plan. So here are the profiles for a PMS plus withdrawal plan can be particularly beneficial. So one thing is, let's say, for example, if you're a retiree and with a capital more than 50 lakhs or 1 crore plus, then having some extent of that in an equity mutual fund or a PMS portfolio would make sense. Let's say if your entire capital is just 50 lakhs, I wouldn't recommend you start a PMS portfolio or so on. Then you can look into something like a mutual fund where your 5 years of expenses are shifted to debt. Remaining, you can just compound at a very conservative, let's say, blue chip mutual fund portfolio also based on the market at that time. So hence, SWP provides a predictable income stream, adding up to much more dynamic approach compared to a traditional, let's say, route like FDs and real estate. Because that's something that I faced at my house also. Because when I asked my parents what is their, let's say, plan for the retirement, they had an assumption, okay, we'll have this property of real estate and we'll get a rental income from that. I asked, let's say, what if you have a big medical emergency? What are you going to do about it? Obviously, like a equity mutual fund or so on, you can't just, let's say, sell out a portion of, let's say, kitchen or let's say hall and then use it for your emergency, right? What if the rental income is stopped in between? So there are a lot of drawbacks in traditional investments like FDs and real estate and so on. But when you combine it with financial assets, it's going to be more, let's say, helpful for you. So let's say retirees in, let's say, higher tax brackets often see a significant portion of FD interest eroded by taxes. In investments like equity mutual fund, PMS, together with a well-structured systematic withdrawal plan, can help you improve your tax efficiency, potentially increasing your post-tax returns also. So one thing is, if you're someone who is looking for predictable cash flows while wanting your capital to grow at a steady conservative rate, this approach can help you strike the right balance too. So PMS strategies can be tailored for your long-term growth, while SWP ensures regular cash flow for your expenses. Or let's say, for example, if you're a legacy planner, if your goal is to preserve and grow wealth for your future, for your grandkids, or it can be inheritance corpus or for your future generation, PMS provides an active portfolio management and diversification, while systematic withdrawal plan also allows you for gradual withdrawals, making it easier to plan transfers or distributions in your retirement. So one thing is, let's say, for example, what I would say as a checklist is, don't just, let's say, rely on one option. You need to diversify your investment based on your risk capacity, your financial goals, and so on. Review your monthly expenses and needs by keeping in a lot of factors in mind. It's not only about returns that we should talk always. It's about inflation, healthcare cost in mind, your emergency corpus, and so on. Let's say if you have an advisor, you reach out to them and see if our investment portfolio in your retirement, what should be a proper asset allocation for you. And obviously, it's like you need to do proper regular portfolio reviews of your portfolio during retirement. And when you have an advisor, that's going to be a win-win situation for you. And let's say, as I spoke about, let's say FD to PMS. So in our Ithought PMS universe, we have 5 different unique products. To quickly touch upon those, Solitaire is a flagship product where we invest across, let's say, multi-cap or let's say flexi-cap strategies in large, mid and small cap companies in India. Second is True Blue portfolio. It's a large cap blue chip portfolio. It's a very conservative portfolio. And this is one of the go-to choices of our retired, let's say, clients. Third is Vriddhi. It's actually a very aggressive portfolio and a small cap portfolio. This is for someone who is looking for a 7 to 10 years compounding time horizon with a higher stomach for accepting any volatility. Second, last one would be Spear or Neo. Spear is for resident Indians and Neo is for NRI investors. So Spear is actually a multi-asset portfolio where we invest across large, let's say, equity portfolios, stocks on mutual fund front, gold, let's say silver, global mutual funds, and so on, and debt portfolios also. So hence it's a multi-asset or all-weather portfolio for you. So hence, based on your risk capacity, if a PM is suitable for you, we can help you choose the right portfolio for you and then take care of, let's say, having a proper systematic withdrawal plan based on your needs and wants. So going forward to, let's say, the fund positioning, as I mentioned, everyone, let's say, all of the attendees that are there today, it's like one thing would be is, let's say, your risk capacity is going to be very different. And hence, this is just a risk chart that we put. True Blue is going to be very conservative. Spear is going to be moderately conservative. Solitaire is a moderately aggressive portfolio, and Vriddhi is going to be purely aggressive portfolio. So that would be a gist about our PMS universe. So thanks all for joining this webinar. It was a great, good session. Was happy, let's say, answering your doubts and queries.